This could be something that we feel at the start of trade here in Europe. FTSE futures are called quite a bit higher than other futures here in Europe. And I note that it was some of the oil majors that weighed on the London market yesterday. And so, I mean, that might be there might be little else to say about that phenomenon, but we might see some outperformance by London as a result of that.
Yeah, I mean, we definitely could see that. I think, you know, the oil story is a smaller story within the broader market context. There's so much going on this week. The U.S. data is certainly having an impact globally. You're seeing ricochets from what we got from non-farm payrolls yesterday in labor markets. I think generally you're more on edge because you have so much data this week. And then we also just have a huge number of central banks tomorrow. And so I think I'd look more towards that and that story rather than kind of littler stories around the oil market. It can certainly impact sector rotation, but I think broadly we're more concerned about how that data and bank decisions evolve.
Well, yeah, I've had to pick between Threadneedle Street and Frankfurt tomorrow for the ECB versus BOE decisions. And, you know, the BOE just had this CPI print come in. You've had traders changing their bets for BOE next year. Which one's going to be more interesting tomorrow, do you reckon, BOE or ECB?
I mean, definitely the Bank of England. I think that's always the case, right? Because you have this vote split that watched very closely. I think, as you say, the data we got this morning, inflation came in lower. I think we very convincingly got data since the last Bank of England meeting that told you inflation peaked in September and it's been on a downtrend since then. And yes, some of the prints maybe haven't been read as clearly by the market in terms of we got wage data yesterday and it was a little bit hotter than expectations. But the key is that you're still seeing that downtrend. So private sector pay was down quite considerably. For the Bank of England, that feeds into services inflation. And so that means you can ease tomorrow. And I think that's certainly helpful for Gilts. I think also what's underappreciated is how much that inflation helps. And by that, I mean you get this kind of virtuous cycle where lower inflation means you have lower yields in the UK, which is lower debt servicing costs, which means you can have lower risk premium and lower yields again. And so that gets this kind of going in a good way, especially because so much of the UK debt is inflation-linked relative to elsewhere.
And so what kind of messaging will the central bank want to attach to any decision, do you think? Will they be happy with the way that the market is receiving all of this? Because inflation is still high, but if you look at the forecast for next year, it's expected to come down really quite quickly. How many rate cuts will the bank feel comfortable with the market pricing in, do we think?
Yes, I think this is the issue is you don't get consistent messaging from the Bank of England. So, you know, there might be some members that say that's totally fine. We can have that many cuts next year. And I think actually the risk is skewed more towards a hawkish meeting tomorrow because of that, or a hawkish surprise, because all of the data has been so clear since the last meeting on the dovish side, inflation coming down. And so it is now fully priced and you are still likely to have a board split. The last decision was very close. And so I think, you know, maybe you get a bit more of a wobble in Gilt. And then I think the outlook's less clear in terms of the pound, and that, yes, risk premium compression and lower policy rates is very positive for Gilt, but it's more of a mixed outlook for the pound.
OK, let's see if maybe we get a sterling rally off the back of a hawkish BOE cut. Well, Bloomberg, Skyler, Montgomery, Koning, thank you so much for that analysis.